Saurabh Mukherjee, in all your books and all the stuff that you write and interviews you say, you always said one thing, right? Follow the cash. Don't follow necessarily the profits, because, and you bring out this whole analogy about how sometimes the companies you invest in, the cash compounds faster than maybe the bottom line. But if we are going to be in the season of M&As, that's going to impact the cash. So what's it going to do to your strategy?
So good point. So firstly, in banking, there is no sort of cash concept, right? You can't really do free cash flow in banking because of the whole construct around how banks fund themselves. So in banks, the number we look at is book value. Book value per share is the main metric to focus on in banks. And as I said, on that metric, the HDFC Bank, HDFC deal looks to us to be very attractive. On the acquisition side of it, what's very interesting, and I'm glad you raised this point, is what smart companies are able to do, and it's in a way that's what makes them almost magical. They're able to acquire, so that eats up their cash as they acquire, and yet within 2 years you see that the acquisition throws off lots of cash. So I will say a good case in point is if you look at Dr. Lal Path Labs. He's been steadily doing, Manchanda has been steadily doing small acquisitions over the last 6 or 7 years. But in spite of that, his free cash flow, Dr. Lal's Path Labs free cash flow has compounded at 35%. Pidilite similarly, over the last 5-6 years, they've done several acquisitions, and yet free cash flow compounding for Pidilite tends to be pushing towards 25%. So the skill of a high-class company is to expend cash on acquiring and still grow free cash flows at a 25% rate. And that in a way is the Sachin Tendulkar type company that we all aspire to invest in and compound our wealth.
Okay, now there are of course some very ambitious milestones that you've spoken about in the past when it comes to growth timelines. As the economy comes back from all of the lockdowns, things are opening up. What is business on ground looking like? We'll first begin with that, and then we'll talk to you about your expansion plans.
So demand in general is quite robust, not just in India, but across the globe. Having said that, there could be impacts in Europe because of the war situation out there. China to somewhat is impacted. However, what is protecting Cosmo Films, and we continue to grow very robustly, is that we are spread over 5 different product verticals: synthetic paper, packaging films, lamination films, label films, and industrial films. So what we have been able to see in all these 8 quarters is that even if 1 or 2 segments are impacted, we are able to catch up in other segments and make sure that we are fully utilized, and we see the same trend. As of now, the demand is quite robust, specifically in India. However, inflation is showing some concerns because we do see FMCG companies talking about that they are not seeing as much volume growth in the past. However, we have been able to replace it with labels and synthetic paper. So some of our specialty segments are growing very well. And this year we have been able to grow our specialty films by 20+%.
Now, when it comes to the fashion bedding segment, China is the market leader on this planet. Can you share with us what your plans are, especially when countries, buyers, brands are looking at a China Plus strategy?
So we have a clear-cut strategy to remain in the bedding side of the business because that is the larger share of the pie. And that's the reason 4 years back we have started investing into this business in terms of both man, machine, money. And we have seen results coming in where as we speak, we are 19% of revenues in our total revenue when you correlate to fashion, utility and institutional bedding. Going forward, as I said, that home has become the center stage and people are upgrading their homes. They are using better products. They are more aware about the health, hygiene and wellness factors. And since we also are connected to the wellness factors because sleep forms an important area in the wellness factor, just like food and fitness, So I think there are opportunities wherein, we can tap them going forward. So certainly you see this will help us gain more share as compared to China, which is losing market share due to the China Plus One strategy where brands and retailers want to de-risk their business to other countries as well where China was dominating. So I think with the cotton coming out from the Xinjiang area also is a big blow to the Chinese textile segment. So I think with all these factors, China is slowly losing the market share and India stands to gain. And as I mentioned earlier as well, like the global textile trade is almost 1 trillion and China holds 35% market share. India holds just 3.5% market share, and 1% market share shift from China is around 10 billion. So that's the scale of things which we see in the near future, where India stands to gain and our company will definitely gain this. And in order to substantiate this, we are building up the back end. We are investing into facilities where we can service the customers very well. Also, we are building up the omni-channel presence in the US and in other markets like UK, wherein we can service the customers with speed. So I think with all these initiatives, definitely we will stand to gain in the coming years more market share on the fashion and utility side of the business.